Silver didn't just fall today, it was pushed. At exactly 9:47 a.m., someone moved 55 million ounces of paper silver. In under 90 seconds, no news, no warning, no reason, unless they already knew what tomorrow's CPI number says. And if that's true, what they're planning next makes today's crash look like a warning shot. Welcome back, dear friend, to Currency Archive. Now, before we go any deeper into this rabbit hole, I want to ask you something, and I mean this gently, the way you'd remind your grandfather to take his blood pressure medicine before the storm hits. Please subscribe to this channel, not for me, for yourself, because the information we're about to uncover today is exactly the kind they don't want sitting in your recommendation feed. One click, one button. That's all it takes to make sure we can find each other again when things get worse. And trust me, they will. Oh, and one more thing before we begin. Drop a comment right now. Tell me, where in the world are you watching this from? Because what's happening to silver today doesn't just affect Wall Street, it affects your street. It began like any other Monday morning. The trading floors were quiet, coffee cups were still warm, screens were green. Silver opened at $78.90 per ounce on February 16th, 2026, and for the first 47 minutes of the session, absolutely nothing unusual happened. Traders were calm, algorithms were steady, volume was normal, but somewhere in a glass office above a city that never sleeps, someone already knew what was coming. And at exactly 9:47 a.m. Eastern Time, they moved. What the charts recorded in that moment was not normal. In under 90 seconds, a single coordinated sell order dropped 11,000 silver futures contracts onto the COMEX exchange. 11,000 contracts, each contract representing 5,000 ounces of silver. That is 55 million ounces of paper silver, materialized out of nowhere, hitting the market with surgical precision, at a time when there was no news, no geopolitical event, no economic trigger of any kind to justify it. To understand the weight of that number, consider this. The entire COMEX registered silver inventory at that time sat at approximately 280 million ounces. Someone just dumped the equivalent of nearly 20% of the exchange's total registered inventory, in paper form, in 90 seconds. Professional traders watching their screens in real time described the moment as feeling like a wall falling. One institutional desk analyst later noted privately that the order flow pattern looked less like a sell decision and more like a detonation. Within 6 minutes, silver had crashed through 77 orders. Within 12 minutes, it had tagged 76.15 and bounced. A $2 or 75 collapse in less time than it takes to read this sentence out loud. The mainstream financial media responded exactly as expected. Bloomberg called it profit-taking. CNBC referenced technical resistance near the $79 level. Reuters mentioned broader commodity weakness. Not one major outlet paused to ask the single most important question sitting right in the middle of that chart like a smoking gun. Why here? Why now? Why today? Because tomorrow morning, at exactly 8:30 a.m. Eastern Time, the Bureau of Labor Statistics was scheduled to release the February 2026 Consumer Price Index report, the single most market-moving piece of economic data released each month. The number that determines how the Federal Reserve thinks. The number that moves gold, silver, bonds, and the dollar simultaneously. And someone sold 55 million ounces of paper silver exactly 14 hours before that number went public. This is where serious analysts stop calling it coincidence. In financial markets, there exists a concept called informed positioning. It refers to the practice of moving capital into or out of an asset based on information that has not yet been released to the public. When it happens accidentally or based on superior analysis, it is called skill. When it happens based on access to non-public government data, it is called something else entirely. It is called a federal crime. The statistical probability of a move of this size, at this precise timing, with zero external news catalyst, occurring purely by chance, is not zero. But it is close enough to zero that serious economists treat it as negligible. Dr. Rosa Hernandez, a commodities market analyst who has studied COMEX positioning patterns for over a decade, described moves like this in a 2024 research paper as carrying a signature. Her words were precise. When informed capital moves before a scheduled data release, it does not move randomly, it moves efficiently, it moves with size, and it moves in one direction. On February 16th, 2026, it moved down. The body of evidence was already forming. The timeline was suspicious. The size was extraordinary. The timing was precise, and the market behaved exactly the way it would behave if someone with access to tomorrow's CPI number decided 24 hours early that silver needed to be cleared of retail investors before the real move began. The anomaly had been identified, but the anomaly was only the beginning. Because when investigators and analysts began pulling back the layers of this specific trade, they did not find one fingerprint. They found a pattern. And that pattern had a history. History does not repeat itself in financial markets, but it rhymes, loudly. And to those paying close enough attention, it rhymes with disturbing precision. What happened on February 16, 2026 was not the first time silver collapsed in the hours before a major inflation report. It was not even the second time, or the third. When serious analysts began pulling the historical data, what they found was not a coincidence sitting in isolation. What they found was a timeline, a sequence of events stretching back years, each one following the same choreography, the same timing, the same fingerprints. The anomaly of February 16th was not a crack in the wall. It was a window. And through that window, an entire architecture of repeated behavior became visible. The first place serious researchers looked was December 2025, exactly 2 months before the February collapse. A quiet but significant event had been documented inside the COMEX warehouse system. Silver registered inventory. The physical silver officially logged as available for delivery had dropped by an unusual volume over a 72-hour window. On the surface, inventory movements in commodity warehouses are routine. Metal moves in, metal moves out, nothing unusual. But what made December 2025 different was the timing. The inventory drawdown began 48 hours before the December CPI release. And in the options market, simultaneously, a cluster of large put positions on silver futures began appearing on the tape. Put positions are financial instruments that profit when prices fall. Someone was not just moving physical silver out of registered inventory. Someone was also buying the right to profit from a price decline before that decline happened. Silver fell 2.3% on the morning of the December CPI release. The put positions closed in profit within 4 hours of the data release. No investigation was opened. No inquiry was launched. The financial press reported the move as a reaction to stronger than expected inflation data. The pattern had recorded its first entry. Researchers then moved further back to March 2025. On March 11th, 2025, one trading day before the February CPI release, silver dropped 1.8% in a single session. Again, no external catalyst. Again, the volume spike appeared in a narrow window between 9:30 and 10:15 a.m. Eastern. Again, the mainstream explanation centered on technical selling and broader dollar strength. But when one independent analyst mapped the options positioning data from the 48 hours preceding that drop, the picture became harder to dismiss. Large institutional players had quietly accumulated short exposure to silver in the days before the release. Not aggressively, not in a way that would trigger immediate scrutiny, but consistently, methodically, like someone reading a map they were not supposed to have. The February 2025 CPI came in above expectations. Silver fell sharply on release day. The short positions that had been quietly built in the preceding days closed in significant profit. The pattern had recorded its second entry. Going back further to the summer of 2024, analysts found a third instance. July 2024. The June CPI release was approaching. In the 72 hours before the official publication, silver experienced what traders at the time described as unexplained selling pressure. Volume was elevated, price action was heavy, and once again, options market data showed a quiet but notable accumulation of bearish positioning in the days prior. The CPI printed hot. Silver collapsed on release morning. The bearish positions profited. 3 separate events, 3 separate CPI cycles, 3 instances of silver experiencing unusual pre-release selling pressure, 3 instances of bearish options. Positioning building quietly in the days before official data became public. When a statistician at a mid-sized European asset management firm ran the probability analysis on these 3 events occurring independently and by chance, the number she produced was less than 1%. She did not publish her finding publicly. She quietly adjusted her firm's silver positioning strategy instead. This is what serious market observers understood by the time February 2026 arrived. The problem was not one rogue trader making a lucky bet. The problem was not one unusually well-timed sell order on a Monday morning. The problem was that the pattern existed at all. Because a pattern in financial markets does not form by accident. Patterns form because behavior is being repeated. And behavior is repeated because it is working. And it keeps working. Because something or someone inside the system is allowing it to continue. The question that Part 1 asked was simple. Was February 16th a coincidence or a crime? Part 2 answered that question. It was neither the first time nor the last. But the deeper question, the one that kept serious analysts awake at 3 a.m. staring at positioning data, was not who did it. It was how. How does information that is locked inside a government building travel to a trading desk before the official release window opens? That question had an answer. And that answer lived inside the system itself. There's a building in Washington, D.C. that most people have never thought about. It sits quietly on 2nd Street Northeast. Its corridors are climate-controlled, its servers are monitored, its staff arrive early and leave late. And inside its walls, every single month, a small group of government economists sit down and calculate a number that will move trillions of dollars across global markets the moment it becomes public. That building is the headquarters of the Bureau of Labor Statistics. And the number they calculate is the Consumer Price Index. To understand how that number could possibly travel from inside a secured government facility to a private trading desk before its official release, one must first understand the architecture of how CPI data moves through the system before the public ever sees it. The process begins weeks before release day. Data collectors spread across the country begin surveying prices. Grocery stores, rental listings, gas stations, medical offices, thousands of individual price points, fed into a central calculation engine. By the time the final number is assembled, dozens of contractors, sub-agencies, and data processors have touched pieces of the larger puzzle. Not one of them signs a document that is enforced with criminal consequences for pre-release disclosure. That detail is not an accident. That detail is a door. The second layer of the architecture involves what the financial industry calls primary dealers. Primary dealers are the 18 to 24 financial institutions officially authorized to conduct business directly with the Federal Reserve. They are the largest banks and investment houses on the planet, names that appear on every major market report. Names that manage pension funds, sovereign wealth accounts, and the retirement savings of ordinary people in dozens of countries simultaneously. These institutions have communication channels with the Federal Reserve that do not exist for ordinary market participants. They receive briefings. They participate in closed discussions around monetary policy. They sit inside the information environment of the most powerful central bank in the world in ways that no retail investor, no small business owner, and no independent analyst ever will. When the Federal Reserve is internally digesting the implications of an upcoming CPI number before it becomes public, the primary dealers are not standing outside the door. They are sitting at the table. The third layer is the one that receives the least public attention. It is called regulatory capture. Regulatory capture is the process by which the agencies designed to police an industry gradually become more aligned with the interests of that industry than with the interests of the public they were created to protect. It does not happen through dramatic corruption. It does not require briefcases of money changing hands and parking garages. It happens slowly, quietly, through career movements, through funding relationships, through the simple human reality that the people who regulate an industry and the people who profit from that industry often know each other very well. The Commodity Futures Trading Commission, the CFTC, is the primary regulatory body responsible for overseeing silver futures markets. Its enforcement division has opened and closed multiple investigations into silver market manipulation over the past 15 years. In 2010, a formal investigation into silver price suppression was launched, following widespread complaints from market participants. It ran for 5 years. It closed in 2015 with no charges filed and no findings of wrongdoing published. In 2019, Deutsche Bank traders were fined for precious metals spoofing, a practice of placing and canceling large orders to manipulate prices. JP Morgan Chase traders were criminally charged in 2020 for running a multi-year precious metals manipulation scheme. The scheme had been operating, according to prosecutors, for nearly a decade before charges were filed. A decade. The watchdog was in the room the entire time. What emerges from studying these three layers together is not a conspiracy theory. It is a structural diagnosis. The BLS data pipeline has access points that have never been fully audited for pre-release information security. The primary dealer system creates an information proximity between government data and private trading desks that exists nowhere else in the economy, and the regulatory architecture responsible for catching and punishing this behavior has a documented history of looking carefully and finding very little. Dr. James Callaway, an institutional risk analyst who spent 11 years inside one of the largest commodity trading desks in North America, described the structure in a 2023 private industry paper with careful but unmistakable language. His words were measured, precise, and deeply unsettling. He wrote, "The system does not need to be explicitly corrupt to produce corrupt outcomes. It only needs to be structured in a way where the costs of exploitation are low and the consequences of detection are manageable. Low costs of exploitation, manageable consequences of detection. That is not a broken system. That is a functioning one, functioning exactly as it was built to function for the people who built it. This is the architecture that serious investors and entrepreneurs must understand before they make a single decision about commodity exposure, inflation hedging, or portfolio positioning in the current environment. Because the question is no longer whether the system can be fixed. The question that Part 4 will answer is far more practical, far more immediate, and far more important to anyone sitting across a desk from a decision that involves real money in a market that is not playing by the rules it publicly claims to follow. The question is simply this: if the game is structured this way, what does a serious, informed, strategic participant do next? There is a particular kind of clarity that arrives when a person finally stops arguing with reality, when they stop waiting for the system to correct itself, stop expecting the regulator to arrive with handcuffs, stop refreshing the news feed, hoping that this time someone in authority will look at the evidence and do something meaningful about it. That clarity is not cynicism, it is strategy. And strategy, in a market structured the way this one is, begins with a single, honest acknowledgement. The informed will always move before the uninformed. The question is not how to stop that. The question is which category a serious investor chooses to occupy. The first thing serious market participants understand is that there are exactly 3 categories of people operating in any given market at any given time. The first category is the informed. These are the institutions, desks, and individuals who have proximity to information before it becomes public. They are not always acting illegally. Sometimes their edge comes from superior research. Sometimes it comes from better modeling. And sometimes, as the previous 3 parts of this investigation have documented, it comes from something far closer to the data source than any retail participant will ever be permitted to stand. Regardless of the origin of their edge, they move first. They move with size. And by the time the public data confirms what they already knew, their positions are already profitable, and their risk is already managed. The second category is the reactive. These are the participants who receive the public data at 8:30 a.m. and make decisions based on it in real time. They are not uninformed. They are simply always one step behind the first category. Their decisions are made on confirmed information, which means by the time they act, the informed have already extracted the majority of available profit from the move. The third category is the unaware. These are the participants who do not follow the data cycle at all, who hold silver, commodity ETFs, or inflation-linked assets without any systematic awareness of how those assets behave in the 72 hours surrounding a scheduled CPI release. They are not unsophisticated people. Many of them are successful business owners, experienced entrepreneurs, and intelligent professionals. They simply have not been given a framework for understanding that the asset they hold does not trade in a neutral environment around government data releases. The goal of every serious investor is to move as far toward the first category as their legal and informational access will allow. The second thing serious investors understand is that the pre-CPI window is observable. They cannot access the BLS data room. They cannot sit at the primary dealer table, but they can read the signals that informed positioning leaves behind in publicly available data if they know exactly where to look. The options market is the first place to watch. In the 48 to 72 hours before a scheduled CPI release, unusual accumulation of put options on silver futures contracts is a documented signal of bearish informed positioning. This does not require sophisticated software. It requires a daily review of the put-call ratio on silver futures options, available through standard market data providers in the days preceding the release window. When the put-call ratio on silver options moves significantly above its 30-day average in the 2 days before CPI, history suggests that serious caution around silver long positions is warranted. This is not a trading signal. It is a risk management observation. The distinction matters. The second signal lives in the COMEX inventory reports. Every business day, the COMEX publishes warehouse stock reports documenting registered and eligible silver inventory movements. When registered inventory, the physical silver officially available for futures contract delivery, declines sharply in the 48 hours before a CPI release. It historically correlates with the kind of positioning behavior documented in parts 2 and 3 of this investigation. Declining registered inventory before CPI does not cause a silver price drop, but it has repeatedly appeared alongside the conditions that precede one. Serious market observers treat it as a contextual warning, not a guarantee, but a data point that changes the risk calculation meaningfully. The combination of elevated put-call ratios and declining registered inventory in the pre-CPI window creates what experienced commodity analysts call a convergence signal. When both appear together, the historical record of the past 3 years suggests that silver downside risk in the 24 hours surrounding CPI release is significantly elevated above baseline. The third principle is perhaps the most important for business owners and entrepreneurs specifically. It concerns the difference between reacting to commodity prices and structuring around commodity cycles. A business owner with silver exposure, whether through physical holdings, silver-linked ETFs, mining equities, or commodity-indexed contracts, who is unaware of the pre-CPI behavioral pattern described in this investigation, is not just exposed to silver price risk. They are exposed to a specific, recurring, calendar-driven risk event that repeats every single month on a predictable schedule, 13 times per year. The CPI release creates a window of elevated manipulation risk in silver markets, 13 times per year. The pattern documented in parts 1 through 3 has the potential to repeat. A business owner who structures their commodity exposure with awareness of this 13-event calendar, who reduces speculative silver exposure in the 72 hours before each CPI release, and who rebuilds that exposure after the data is cleared and the informed positioning has resolved, is not gaming the market. They are simply refusing to stand in the path of a known vehicle on a predictable road. The final and most sobering strategic observation belongs not to the individual investor, but to the broader business community watching this investigation unfold. Markets that operate with this level of structural asymmetry do not self-correct quickly. The regulatory history documented in Part 3 makes that clear. The pattern history documented in Part 2 confirms it. And the architectural reality documented in Part 3 explains why it persists. What changes is not the system. What changes is the awareness of the people operating inside it. Every business leader, every aspiring entrepreneur, every young professional building their first serious investment framework in 2026 needs to understand one foundational truth about the market environment they are entering. The price on the screen is not always the product of supply and demand. Sometimes it is the product of a decision made in a room they were never invited into, based on a number they were never permitted to see, executed by a desk that understood exactly what was coming, while everyone else was still checking their phones. That is not a reason for outrage. Outrage without strategy is just noise. That is a reason for precision, for observation, for building the kind of disciplined, data-aware, calendar-conscious approach to commodity exposure that transforms an uninformed market participant into a serious one. The CPI will be released again next month, and the month after that, and the month after that. The question is not whether the pattern will repeat. The question is whether, this time, you will be watching the right signals before the 90 seconds begin.